The era of robotics has arrived. One day, everything that moves will be autonomous. Researchers and companies around the world are developing robots powered by physical AI. Physical AIs are models that can understand instructions and autonomously perform complex tasks in the real world. In a virtual world that obeys the laws of physics. In these robot gyms, a robot can learn to perform complex and dynamic tasks safely and quickly, refining their skills through millions of acts of trial and error. We built Nvidia Omniverse as the operating system where physical AIs can be created. Omniverse is a development platform for virtual world simulation, combining real-time, physically based rendering.
Coming up today, why the market may be about to roll over, where a recession could take the S&P 500, peak optimism in tech stocks, Nvidia finishes the week lower, the latest in commodities and geopolitics, and I get you prepped for next week. And a warm welcome back to the Daily Market Review, your favourite finance channel, giving you all the most important and latest news, data and charts from across financial market, helping you to make better financial decisions. Welcome everybody, my name's Jared, and if you haven't already, hit that subscribe button to stay updated every day on what's happening across markets. And I appreciate all you guys hitting that like button as well, helping the Daily Market Review to break out to new records every single month in viewership. And so let's dive right in. Market pulling back a little bit here to finish the shortened trading week. We were shut Wednesday for a national holiday. And so something we've been watching of late is deteriorating market breadth and a growing consensus that's going to cause the entire market to give way. However, as I'd been arguing over the last couple of days, I think it could be more of a case of Nvidia pausing and pulling back, allowing for the rest of the market, especially small caps, to start catching up. And it looks like that's already started today. We can see the S&P 500 and NASDAQ. Underneath the 5-day, well, we've got the Russell, energy, discretionary, industrials, and financials. Also above the 5-day, well, we've still got Bitcoin, now growth versus value, momentum, and growth indices. Pulling back here in the short term today as well. S&P finished a bit lower, as did the NASDAQ, and we had the Russell 2000 actually finding its footing on a bit of a hammer candle formation here. The dip was bought, finished a little bit higher here. Volume breadth's holding up there, and actually we've just had the 4th consecutive increasing day in short-term breadth. Amount of stocks above the 20-day average, and same with the amount of stocks above the 50-day average, actually improving these last few days as well. Still not showing up in new highs versus new lows though. And a typical Friday, we finished a bit lower on the VIX, 13.19. Volatility risk premium just kind of flatlining in the middle there. Intercorrelation in this market, super low, just about as low as you'd see it. There's quite a lot of dispersion in this market. Skew index actually popped up today, price of out of the money put options. Bond yield's pretty flat for this short trading week. Got the 2-year at 473. Same deal with the 10-year at 425. High yield bonds still holding up really well above the 50-day. There's a dollar index actually firming there today, breaking out to a new monthly high. And Bitcoin continuing to peel back here, making this market a bit interesting. Big sign of risk on sentiment, liquidity pulling back a bit here, going back into this consolidation zone. There's gold reversing course after yesterday's gain, and crude oil just catching its breath after a multi-week swing high. And what was interesting today, Apple pulling back firmly on massive volume. It's also triple witching OPEX today. Wasn't anything too big and exciting on the options side of the market. It was actually quieter than yesterday. However, a few key stocks, we saw some massive volumes coming in. Apple being one of them, and of course the most important one we were watching this week, and especially yesterday after that big bearish engulfing candle, Nvidia. We've already got some follow through, taking out the weekly lows. We finished this week down more than 4% on big volume, but it was a bit of a spinning doji, indicating indecisiveness from the market. Did gap down, finish a little lower, however it was supported somewhat by buyers. Also interesting with a little bit of a rotation out of Nvidia and Apple into other areas of the market, small caps. Also into some other mega cap techs that have been lagging behind, like Amazon. Firming really nicely here today on volume, finishing near the highs. And the best looking chart of all mega cap tech is Alphabet Google, putting in a solid fat candle on more than double average daily volume, close to all-time highs. Really good, strong uptrend, and that been consolidating this past month versus the massive rip we've seen in Nvidia. So at this point, Nvidia peeling back didn't seem to shake the overall market, and instead we're getting what I thought, and that is a rotation into other areas of the market that have been soft of late. However, since Nvidia is actually responsible for over a third of the S&P 500's gain year to date, it could continue peeling back the S&P 500 headline market cap index that we all look at every day. And because, like I'm about to show you soon, at a look at some market internals, options and technicals looking a bit stretched, we're also getting economic data softening of late as well. US labor market definitely showing signs of softening, increasing initial jobless claims, very well possible the next unemployment print we get in 2 weeks from today could be 4.1, 4.2%. We also got the City Economic Surprise Index breaking down to new multi-year lows, which is indicating softening conditions in the underlying economy. And we just saw that again today with leading economic index falling in May, driven primarily by a decline in new orders, weak consumer sentiment about future business conditions, and lower building permits. And federal aggregate credit, shown here in the bright green line, forecast to turn lower over the next month and a half as well. Same with the amount of debt held by the public. And just looking back in history, the S&P 500 in the dark blue here, bit of correlation between those two lines. And so federal aggregate credits, the amount of bank reserves, liquidity, loans, kind of think of it as a measure of the amount of liquidity out there in the market. And so is this just the Goldilocks soft landing where the economy pulls back a little bit, unemployment goes up a little bit, without anything really breaking, allowing the Fed to gradually pull back interest rates, stock market can keep grinding higher on low volatility? Or is this economic softness going to accelerate to the downside and turn into a full-blown recession? Who knows, maybe even depression. And if so, where could that take the S&P 500? Well, we're currently just below 5,500 on the SP, with a forward PE somewhere around 20, 21, and increasing EPS estimates from the street. So typically in a recession, what you'll see is a significant and sometimes sharp decrease in analyst estimates on earnings over the next 12 months. In addition to that, a contraction in the multiple the market assigns as it goes into a lower growth phase. And so if we see a hypothetical change in forward earnings estimates from current levels, just minus 10%, and just taking that forward PE back to 16, that would take the S&P 500 to 37.27. And that's actually a moderate forecast for a change in forward earnings estimates and a forward PE in a recession. And believe it or not, that would still be above the lows from October 2022. However, it would be quite painful for most, as that would translate into a greater than a 30% pullback in the stock market, which again is another moderate forecast for a recession. Because again, just looking back at history, prior to COVID, the average forward PE on the S&P from 2012 to 2019 was 15.8, just below 16. And looking back at previous recessions, at the 12-month forward earnings per share drawdown from the previous peak, back in COVID it was 21%, GFC was 39%, early 2000s it was 18%. So that model we just used for 37.27 was assuming a forward PE of 16 and a pullback of forward earnings of 10%. If we were to use the same forward PE of 16, however, we were going to get somewhere like a 20% pullback in forward earnings per share. That would take us down to 3,300 on the S&P, and a deep pullback in corporate earnings expectations would take us down to about 2,900 on the S&P 500. And again, believe it or not, even in that worst case scenario, it should still be above those COVID lows in 2020. But again, would be really painful for a lot of people, as that would be about a 46% drawdown. So for the here and now, the street is expecting good things for the rest of the year and going into next year, expecting the S&P 500 to report earnings growth of 11% for calendar year 2024, and for calendar year 2025, earnings growth of 14.3%. Keep in mind the street is not always right, and when they're wrong, just like the Fed, they can be massively wrong. And so that divergence between small caps and large caps not only has been at extremes in the short term, but also in the long term. In fact, we're hitting some new records, like the longest stretch without the Russell 2000 hitting a new record when the S&P 500 is at an all-time high. And we can see it's only been 3 days since the S&P 500 has been at an all-time high. However, 651 days since the Russell 2000 was at a record high. And there's a look at a long-term monthly chart of the Russell 2000. Peaked out November 2021, 2458. Here we are at 2022. And there's a long-term spread chart between the Russell and S&P 500 indices. Absolutely smashed this last month down. Not only decade lows, but you'd have to go back to 1999 to see the ratio of this spread chart lower. And there's a look all the way back to 1987. So could it go lower? Sure, definitely. Nobody knows the exact bottom. However, could it also be setting up for potentially another 15 years of outperformance over large caps? Well, judging by history, that's more likely to happen than not. But for here and now, again, we're breaking records. By some measures, we're in the longest secular bear market for small caps versus large caps. Again, over the very long term, smaller stocks tend to outperform larger stocks. However, as you can see shaded here in the red column headers, is periods of small cap, large cap bear markets, shaded in the white on the chart, and we can see that underperformance and bear market in smalls versus bigs going on longer than any other time in history. However, I can tell you right now, this is really contrary to popular belief, what I see on social media, In fact, anytime I talk about this on my videos, I usually have at least 1 or 2 people coming at me saying it's wrong or why this time is different, like we're never going to see these shaded green areas again on this chart. However, what I think you'll find is those people are basing their expectations and their decisions for that matter based on their own experiences and feeling rather than looking at hard data going over the long term. Again, I'm not saying small caps are about to start outperforming right here for the next 10 years. My argument is we're closer to a bottom than a top, something to keep in mind as long-term investors. And I'm not talking just about a bottom in technicals either. There's actually a forecast for a closing of the gap between the earnings growth between large caps and small caps. For the last 2 years, large cap, especially growth and tech, have absolutely ripped ahead in their earnings growth versus small stocks definitely deserved to outperform over this last couple of years. However, looking next year, 2025, the expectation is small caps will actually grow earnings faster than large caps. Same again for 2026. Again, no one knows exactly 100% what's going to happen in the future. However, if this to play out, it would give a huge tailwind to the closing of the gap on the actual spread between the Russell and S&P. But for the here and now, it's largely been a large cap growth tech stock dominated market on very low volatility. In fact, the stock market is in its longest stretch without a 2% sell-off since the financial crisis, having gone 377 days without a 2% sell-off. And nothing changes people's minds like price, and so we could be starting to hit some peak optimism here. Largest ever weekly inflow into tech funds. Last week, $9 billion went into tech stocks. Also, the largest ever weekly inflow into US growth funds, exceeding $10 billion. Saw similar peaks back in 2021. Not only that, we've got mega cap growth and tech net call option volumes screaming higher these last few weeks, even eclipsing the peak from late 2021, just before the market rolled over. Another big divergence between the rest of the S&P 500. And we can see that again today in the options market. Not all that busy for triple witching. Third Friday of the month, last month of the quarter, but still lopsided towards calls, 58%. However, just like we've seen on the charts, Nvidia is running out a bit of steam this week. And as this article correctly points out, Nvidia has boosted the S&P 500. Like I said, responsible for over a third of its gains year to date. So what took it up could also take it down. And its success could be the stock market's problem, because for the here and now, we are definitely a bit stretched. Got that big bearish engulfing candle yesterday, and I wouldn't be surprised if Monday, Tuesday, we come up and retest maybe the midway mark. However, if we were to close above the high, that would invalidate the bearish engulfing candle, but we could pull back, consolidate, and then roll over again. You can see that pattern play out quite a lot with these bearish engulfing candles, but the momentum at least has definitely been challenged, and I'm not saying this is the top in Nvidia, however it could be, because just looking at that monthly chart, just like the daily, we're definitely stretched here, getting some overbought conditions, and just zooming out to a clean long-term monthly chart. That doesn't look like a sustainable price action. It actually looks a bit toppy here and could be in the process and putting in a shooting star candle if we were to finish a bit lower here into next Friday. And that doesn't necessarily mean we're going to crash. We may just pull back and find support around 60 or 70 and just drawing a Fibonacci retracement on the low to the high. If that is the high, 142 post split, then a 50% pullback would be 76. However, after huge massive run-ups, what you typically see is that golden pocket pullback around 61% or so. And that's what I said takes us down to about $60 a share, which would be a 50% pullback, which again is not all that uncommon after massive run-ups. Even if the fundamentals remain strong, if the market just decides to re-rate them on multiples, analysts downgrade their earnings expectations, and if anything goes wrong with their growth story, if a big customer cancels orders because of a softening consumer or any signs of de-accelerating growth, then that just could give the market a reason to change course. And then just like in a crowded movie theater, if a fire breaks out, everyone rushes to hit the exit doors as soon as possible, and that causes the wave to roll over. However, for the here and now, the AI bull is still in full swing. We're yet to see whether we've topped out at that big price action in Apple after their Worldwide Developers Conference. Looking like this street is on board with that and forecasting for them to get back to growth next year based on this and the new iPhone upgrade cycle, which if it doesn't materialize, then Apple too could experience a sharp and deep 50% pullback over the next year or two, which again would catch many people off guard who have come to believe that it can only go higher. And it's not just Nvidia and Apple. We've also got Amazon, Alphabet, Tesla, and Meta digging their heels more and more into the AI space, and Wall Street and investors at large are loving it. See tech valuations getting to lofty levels, momentum, call option volume And of course, they've been outperforming since that low in October 2022. But their performances since then have varied wildly. Just going through the monthly charts on them, there's Apple, Microsoft doing a lot better, still sitting at all-time highs. Nvidia, super stretched. Amazon, the second worst performing out of the mega cap tech, still just under all-time highs though. Alphabet just about as firm as Microsoft. Meta on an absolute tear, looking a little stretched as well. And the worst performing, and the only one not in the $1 trillion club, Tesla, still well off those highs from late 2020. Moving on to bonds, we did have a bit of a pickup in yields this week as the market looks forward to inflation and growth data. We have GDP coming next week, unemployment report the following week, and each of these next inflation and jobs reports are going to carry more weight than their previous ones as we get down to crunch time for Jay Powell and whether he's going to get a cut done before the federal election. And I'd say if we just get a couple of more inline prints or soft prints, I'd expect them to cut in September. And just looking at the price action of the 2-year yield, that's pretty much saying the same thing as well. Just pulling back here to 473. Current Fed fund rate at 525. There's the 10-year, 425. But still holding up, not really giving way too much. If it started dropping sharply under 4%, bond market would be telling us it's seen a lot of problems in the economy around the corner, and I'd probably agree with the Fed Fund futures pricing as well. 2/3 chance we're going to cut in September. That's probably where I would put it as well. But for December, that's just too far out. A lot could happen between now and then, especially with the federal election, so who really knows? But it doesn't look like we're going to get a cut next month. However, I think it's seriously on the table for September, the last time they meet before the federal election. And that could look really politically charged as well, going into an election if he does cut. But as Jay Powell says, politics doesn't play into his thinking, apparently. But why he really needs to cut as soon as possible is like his good friends, like Elizabeth Warren in Congress, remind him US debt's out of control. US government is going to have a hard time paying it all back if rates keep staying up here. By some estimates, US debt will surge to $56 trillion in the next 10 years. As government spending outpaces revenues, currently around $34.5 trillion. And so according to the latest projections from the Congressional Budget Office, they think the debt's going to increase by 64% over the next 10 years. And it's not just us market observers noticing that. It's also some of the largest holders of US dollar assets, countries like Saudi Arabia, who for decades have given us their oil in exchange for US dollars, which they then buy US Treasury, US stocks, US real estate, helping to keep borrowing costs for the US low and valuations for growth assets high. However, them, along with many other major buyers of US dollar assets, are pulling back and actually pursuing de-dollarization, forming their own currencies, forming their own trade partnerships as the rest of the world continues to catch up to the West and gain a lot more bargaining power with it. It's been reported that Saudi Arabia has not renewed a deal that ensures the use of US dollars in oil trade. The end of this petrodollar agreement will dent dollar dominance, the Atlantic Council wrote. Instead, they're looking to sell in multiple currencies, including the US dollar, but like many other countries, they're aligning more closely with China, looking to trade in the yuan. And that's why these countries are switching their international reserves, where they keep their saving, nest egg, piggy bank, whatever you want to call it, from US dollars, gold. Looking at the change in gold reserves for 5 countries over the last 5 years, increase in tonnage, China 377, Turkey 285, Poland, India and Russia all significantly buying a lot of gold. And I think that's a big driving reason why we've seen gold appreciate a lot over the last year as central banks accelerate their gold buying, even though investors at large have pulled out money from gold ETFs, surprisingly, over the last 2 years. Still well off highs from 2020, amount of assets under management in accumulated gold ETF holders. So we've been having a bit of a pullback in commodities this last month or two. You can see that on the chart of DBC, Commodity Index Tracking Fund. Bit soft here, consolidating for the last couple of months. Even agricultural commodities, been tracking sideways for a few months. Uranium's pulled back a bit. Even the hot cocoa, one of the best trades this year up until April, that's been flatlining for a few months. And just looking at the commodity growth spread, copper versus gold, pulled back significantly as well. So looking at the bond market and commodity market, they're both forecasting a bit of economic weakness around the corner. But like I said, for the S&P 500, not yet. Because even though the current administration has done a good job at keeping the price of oil down, it's been climbing steadily these last couple of weeks, surprisingly. And the last measure on oil and gas inventories actually pulled back a little bit this last week as well. Also going into that busy driving season in North America, 4th of July coming up. And of course, we still have 2 active wars going on in major oil producing regions. And once again, Russia's Vladimir Putin continuing to talk about nuclear weapons as we seemingly approach a boiling point, in which he's saying that thin red line is close to being crossed, in which he may be forced to act and push back as Ukraine continues its path to becoming a NATO member, which initiated this whole war to begin with. We've also got Hezbollah dialing things up against Israel, could be adding to the upward bid in oil. We know we're not seeing a huge spike. We've got strong opposing forces going on there, but any further spikes in oil could really upset the picture, Biden's chances of re-election, keeping him into office into the ripe age of 85. However, we're still yet to really see how far Hezbollah is going to go, because as soon as Israel responded to Iran on a precision strike that got through their defenses, unlike the 350 missiles sent from Iran that didn't make it to Israel, shot down thanks to the West. Maybe Iran doesn't want to dial it up, or maybe they're cooking something with Russia and North Korea to try and upset Biden's chances of re-election. Now, with crude sitting here just above $80 a barrel, say the current administration and the market at large really doesn't want to see it go too much higher, nor take out these highs from April. Otherwise, that's going to cause inflation problems, really put J. Powell between a rock and a hard place, and get consumers not feeling so great going into an election either. Paying out the nose for gas. Anyway, we'll see what all that brings. For the here and now, a lot of Americans are experiencing a heat wave. Tens of millions from the Midwest to the Northeast have been under extreme heat alerts this week. Temperatures broke records in cities such as Boston, which hit a high of 98 degrees on June 19. Hot weather is expected to continue into next week, and unfortunately, this is a growing long-term trend. In fact, the average number of heat waves in the US annually has tripled in the past 60 years. And it's not just environmental impacts, there's also impacts on productivity and can affect industries like agricultural, loss of crops, insurance companies having to pay out, and this is why we're going to continue to see our insurance rate climb significantly as they have been and going into the future, as last year was the world's warmest year on record and by a decent amount as well. Moving on to what to expect next week. Pretty slow start to the week. New home sales on Wednesday, durable goods orders and GDP data Thursday, Friday, personal income, PMI's Michigan Sentiment Survey. Then we'll finish out the second quarter of the year and the first half. Going into the second half, Q3, we kick off Monday. Manufacturing PMIs. Wednesday will be a big one. ADP employment. Services PMI, factory orders will be shut again for Independence Day, July 4th, then the first Friday of the month, jobs report. And there's a look at the economic calendar we got today. Retail sales year over year, United Kingdom climbing 1.3%. However, keep in mind that's absolute figures. That's not real or adjusted for inflation. Their inflation running about 3-4%, depending on what measure you use. Adjusted for inflation, that would be down. PMIs across Europe coming in weaker than expected, with Eurozone manufacturing PMI well below expanding levels of 50, although services still expanding. Retail sales in Canada lower than expected, up 1.8% year over year. In America, once again, the exception, doing a lot stronger than other developed countries. Manufacturing PMI is still expanding, better than expected, along with services really strong, 55, creating a composite of 54, and existing home sales actually contracting month over month, as there's further signs of the housing market pulling back as well as the consumer. Going the other way is manufacturing, big business, and of course government with record spending. For ingredient next still at 41. We might actually see this do the opposite of late, bounce back as the S&P 500 pulls back as we've had this record divergence and market breadth. Bit of a growing gap there on yesterday's data for corporate insiders overall. Amount of buying versus selling starting to get a bit stretched. More corporate insiders bailing. And just looking at notable corporate insider purchases and sales this past week. First looking at buys, see a few of them showing up in the resources area. PBF Energy, Occidental, Talos Energy, Franklin Resources and Exxon. And you can see most of them are closer to their 52-week lows than highs. Contrasting that, looking at insider sales, much larger, coming more from tech. Michael Dell offloading big, over $400 million worth of Dell stock sold from insiders this past week. Also up there, another hot stock, Eli Lilly, MasterCard, Applied Materials, and again the opposite, insiders, as you'll often find, selling near 52-week highs. Also showing up, Uber, Nvidia, Workday, Airbnb, insiders doing some notable selling. And there's a look at the spread between the Russell and S&P ETFs. Maybe bottoming out this week, got some reversal signals here, well below the 50-day VWAP, and climbing there a bit today, spread increasing by 0.68%. Similar story for dividend growing stocks, which I pointed out earlier this week, are also oversold versus S&P, putting in a pretty good recovery there the last 2 days. We'll see if that can hold on. Same deal with value stocks versus S&P, potentially looking to have bottomed out. Okay, so to summarize, market pulling back a little bit here, thanks to that pullback from Nvidia today after that big bearish candle yesterday. Like I said, it still may consolidate, retrace back a bit next week. We'll see this wave flow indicator bunch up, coil up, and then may change color again. And if it were to go red, then that would be in a downtrend, and I'd say a good chance it'll pull the S&P 500 into the same pattern. Whether that turns into a full-blown correction, dive, is yet to be seen. I think is still unlikely, looking at the VIX and volatility market, election year seasonality. Medium term, the trend is still up. We should still finish the year higher. We just may have gotten a bit ahead of ourselves here, up 15% year to date. And even though we're going into a bit of a bullish seasonal period, like I said, we got ahead of ourselves, got Fed and credit conditions suggesting we could have a pullback. And instead of a full-on market-wide pullback, like I said, may just be a continued rotation into what's been underperforming lately, Russell 2000. Anyway, that's the tale of the tape my analysis and opinion. As always, you don't have to agree with everything I've said. You're welcome to leave your thoughts and opinion below this video, and I read and reply to every single one. Other than that, have a great relaxing weekend, and I look forward to making you another video Monday night. Cheers.